Hey, what's going on, guys? Welcome to the Active Duty Passive Income Podcast. We have another legend on the show, Tom Wheelwright. How's it going, Tom?
Great. I hope I'm not so old that I'm a legend, but thank you for that.
No, sir, you are definitely a legend, and there's no age range in that. I mean, your your experience precedes yourself, and I know our audience is super excited to have you on here, especially now that we're right in the heart of tax season.
We are.
Yeah. But for those of you who are not familiar with Tom Wheelwright, he is the CEO and founder of Wealthability. He's also the author of Tax-Free Wealth, which is one of the Rich Dad, Poor Dad books. And he is a legend in the tax space. He helps millions of people around the world. And Tom, we're really excited to have you here. Thank you so much for talking to our military veteran community.
It's great to be here, and just thank you. Just thank you for what you're doing as well.
Thank you. Thank you. So, Tom, can you give us a little background on how you got started in tax advising?
Yeah, of course. So I grew up in Salt Lake City, Utah, and went to the University of Utah after I served 2 years as a Mormon missionary. And so my buddy Robert Kiyosaki says that between being in Vietnam and being a Mormon missionary in Paris, he'd rather be in Vietnam. He said what he was doing, he thought was way easier. He was flying helicopters in Vietnam, and I was selling Mormonism to Catholics in Paris.
Oh man!
So that's actually my first entrepreneurial, really entrepreneurial experience, because I really learned all about rejection during those 2 years.
Right.
As you get door after door slammed in your face. But it was absolutely great. I love Parisians. I love Paris, my favorite place on earth. And from there, I went to the University of Utah. I have a bachelor's of accounting, and from the University of Utah. And then I went to the University of Texas, where I have a master's of tax degree. And then I spent 7 years with Ernst & Young, one of the, actually the largest CPA firm in the world. And was there actually the last time we had major tax reform. I was in Washington, D.C. with Ernst & Young following the legislation, and actually helping to write the book explaining that legislation to our CPAs and our clients around the country and around the world.
Wow.
And then I spent 4 years as the in-house tax advisor for what was then a Fortune 500 company here in Arizona, and spent 14 years as an adjunct professor. They actually asked me to create a new class on state and local taxation, because that's a very, as we all know now, that's a very big area of tax law right now.
Right.
And so I did that for 14 years as an adjunct professor, and started my own CPA firm just about 25 years ago. And now I'm running a network of CPA firms where we have clients in 50 states and 30 countries. And as you know, I spent a lot of time traveling the world with a veteran, Robert Kiyosaki. And we talked to people all over the world. We were in Australia last year. We were in South Africa last year.
Wow.
We're going to be in Europe this year. We're going to be in Asia this year. And what's fascinating is that wherever we go, invariably, literally, I was in Dallas last week, and I knew this was going to happen. I actually told the audience this was going to happen. Somebody's going to come up to me and say, "Tom, this is great, but you can't do that here." And it just blows me away. Robert always laughs because that person will invariably show up. And so anytime I talk, there's always going to be somebody who says, "You can't do that here." And the way Robert puts it, he says, "You're right. You can't do that here, but I can."
Nice. All right. There it is. And so that experience, man, I'm telling you, that is awesome.
There's a lot. You'd think I'd have to be 150 years old for that, wouldn't you?
Maybe, right? But no. I mean, you just have to be the tax god of the world, pretty much. So that is a
great man accomplishes things very quickly.
There you go. Well, I did only spend 2.5 years in college, so I do tend to take the short route.
Oh man, that is awesome. 2.5 years. I wish all college was 2.5 years, but but anyway, that is awesome. So Tom, you've seen it all, right? And you understand the tax code in and out, as you have said. So can you explain to us the mindset, right, that people should have towards taxes? Because I think that people honestly see it as this bad thing, right? This thing that everyone wants to avoid, but they just hate it and they don't do anything about it until tax time. And then maybe they crunch some pennies together and see, okay, well, now I have to pay this amount, right?
The challenge is that most people equate tax law to the IRS. So tax law to tax collection. And the tax collector is not your friend. Okay. I'm never going to tell you that the IRS is your friend. That isn't, we're the government, we're here to help, right? That is not the case.
Right.
However, the tax law is your friend. So what most people don't recognize is that, there's only one line in the tax law that says all income's taxable, basically, unless we say it isn't. And then there's another line that says no expenses are deductible unless we say they are. And there's a few pages of charts and tables tell you how much tax to pay. But there's 6,000 pages of tax law. And that's just the law itself. That's not the regulations, the rulings, the cases, or anything like that. There's millions and millions of those, okay? What people don't recognize is that of that 6,000 pages, 99.9% of it is really an instruction guide on how to reduce your taxes, because these are all the ways the government gives us incentives for reducing our taxes. I mean, it's simple. If you rent a house if you're a renter, you get no tax break. But if you buy a house, you get a tax break. So that's the government saying, we would rather you buy a house. We'll give you a tax break if you buy a house. Right. Now, ironically, if you buy a house, you get a small tax break. If you build housing for a lot of people, you get a big tax break. So the more people you serve and the more you do that the government wants you to do, the actual more taxes you save. So to the point where you really can, the book is called Tax-Free Wealth, and you really can get to tax-free wealth if you do what the government wants you to do. And that's where people go, well, I want to pay my taxes. I want to make sure that, because I don't want to cheat the government. I'm going, you're cheating the government if you're not taking advantage of the incentives that they're offering, because what they're saying is, if you do this with your time, if you do this with your money, if you spend your life this way, then what's going to happen? And hang on, I have an urgent issue here. I'm going to lose you. Hang on.
Oh, okay. No worries.
Batteries on max. So what's really going on is that one way or another, we're partners with the government. Okay. I mean, that is the fact, look at your withholding. You have a partner that takes money out of your paycheck and you can do nothing about it. Right? So you're partners with the government. The question is, are you a good partner? What kind of a partner are you? Or is the government, are you a silent partner with the government? Or are you an active partner with the government? Right? And so the government says, look, here are things we want to do, either to create energy, to create jobs, to create housing. If you do these things, then we'll give you a tax break for doing them. That's your incentive to do it. Because some things have a lot of risk. For example, invest in oil and gas. That's a risky investment. You're risking the price fluctuation. You're risking, is there oil there? You got environmental risks. I mean, there's all sorts of risks. And so the government says, look, if you take that risk, we'll contribute. We'll contribute so that we'll lower your risk. Right. But what it turns out, the way it turns out is it's like, for example, if you're a business owner, you get to buy things on sale every day because the government's contributing towards the purchase price of what you're buying. So as long as you're following the law and you're doing what the government wants you to do, really those tax benefits, that's the opposite of cheating. That's actually doing exactly what the government wants you to do.
Right, exactly. And that's awesome. I mean, just the way depreciation works. I mean, Brandon was helping me out with this the other day too, and he was explaining to me, some of the specifics on depreciation, right? I mean,
oh my heavens, bonus depreciation right now is amazing, isn't it?
Yeah, you got to love the Tax Cut and Jobs Act for business owners, particularly small business owners, with the way that they've changed that. It's, you pretty much can pay no taxes for the first few years if you really do it right. And you're absolutely right. When you're talking about being a partner with the government and doing things that they want you to do. For example, they want to invest in electric vehicles. So they give electric plug-in vehicle credits to individuals and business owners. They want people to buy these things to get them cheaper overall over the next couple of years. And the same thing goes for like handicapped access. You can build a handicapped access for your business and you get a tax credit for it. Child education as well. It's the same way. So I completely agree with you as that.
Awesome, man. So now all Teslas are on sale. So guys, if you're thinking about going to buy a Tesla.
You know, Tesla's running out of credits. So
are they running out? Oh, wow.
Yeah. So now you got to go buy a GM or a BMW. I'm going to buy a BMW. I mean, my wife has a BMW electric car. They like get 100 miles per charge. I mean, that's it.
Ooh,
but you know, Tesla's over there 200,000. So now you're not going to get the credit, and actually that'll phase out, I think, by the end of the year on Tesla. But there are new car companies coming out, and guess what? Those new car companies still have those big credits. So it's a really good point.
There we go. All right. So make sure you guys look for some of those. That's awesome. So Tom, can we talk more about some of the specifics for tax benefits as they pertain to real estate investors?
Oh, yeah. So real estate. So around the world, just as an FYI, around the world, real estate is the best tax shelter. And it's true in every country. It's just not as true in other countries as it is now in this country. This last tax law change has made real estate, let me tell you just how good the real estate tax benefit is. You know, a lot of people think, well, I've got all my money tied up in my IRA. And if I pull it out, I'm going to pay this heavy tax and this 10% penalty, which is true. You are. And so they're going, so now I'm going to just buy real estate inside my IRA. Well, I never liked that idea in the first place, but now it makes no sense whatsoever, because you can actually get your tax benefit first year. If let's say you took $100,000 out, okay? And I just did this math yesterday, so that's why I know this, okay?
Right.
So you take $100,000 out, and let's say you're going to pay 40% tax and 10% penalty. You're going, well, I'm down $50,000, right?
Right.
But if you take that $100,000, borrowed $400,000 from the bank, and bought a $500,000 investment property, which you could do all day long, right?
Right.
Or buy $100,000 investment properties, whatever you want to do. You go buy that investment property. Your first year deduction is likely to be in the neighborhood of $150,000. You put $100,000 in, you get $150,000 deduction.
What?
Well, Brandon can run these numbers for you, but what happens is that it's the deduction. Remember, if you got $150,000 deduction, you've only got $100,000 of taxable income from your IRA. So you got $50,000 of excess deduction, and that $50,000 more than makes up for the 10% penalty. That makes up for the penalty. So you actually have this. You are net better off. This is how good real estate is, tax-wise. You are net better off pulling the money out of the IRA and investing in the real estate. You're better off tax-wise than if you left the money in the IRA.
Wow! Oh my gosh!
I run the numbers. It just blows me away.
That is mind blowing. That is absolutely mind blowing. So
yeah, real estate is probably the most favorite thing as far as I'm concerned, that the Internal Revenue Code and the Treasury regulations, there's so much that they protect with real estate. And it's because America relies so heavily on the real estate market to succeed in order to further the growth in the GDP in the country. So real estate is definitely by far one of the best things. There's so many deductions. I mean, for example, you have rental property, who's not paying self-employment tax? You run a business, an active trader business as a single member LLC, then you have self-employment tax. You might work just as much, but you're avoiding a lot of different taxes that way.
That's awesome, man. Oh my goodness. That is awesome. So for the military specifically, we have this thing called Thrift Savings Plan, right? TSP, which is kind of like a 401k, but it's same thing, right? Retirement account. So we can't touch it while we're in the service. But when you leave service, that's the time where you have the option to roll it over into something or to take it out and invest. So it would be better for us then, right? If we have left the service, to take it out and invest it in something like real estate, take the hit, because the benefit would be better for us, right?
Well, I would back up just a minute, okay? If you want to invest in real estate, then investing, and you want to use leverage to invest in real estate. In other words, you're not paying cash for the property, okay? Right. One of the best benefits of real estate, of course, is leverage, right? The bank will lend you the money.
Exactly.
Well, if you want your maximum leverage and you want to invest in real estate, then yeah, I would take it out of my IRA. On the other hand, I would never do that until you got the education that you need in order to be successful in real estate. So leave it in there until you get educated, because the worst mistake you make, and talk to anybody who lost money in 2008, 2009, okay? I'm one of those, all right? You get it. You do not plan on appreciation. You really focus on the cash flow. You really understand that this is about cash on cash return, right? That's what it's about, actual cash. Tax benefits are a bonus, but they're not the reason to get into real estate. So, you really get educated. And then, yeah, I mean, but there are a lot of, okay, I know you guys love real estate. I'm going to tell you, there are a lot of ways to make money, and real estate is one of them. And it happens to be right now the most tax favored. And I like Brandon's explanation. I'm sure it has nothing to do with the fact that we have a real estate developer in the White House. That has nothing to do with there being massive tax breaks on real estate.
Of course not.
Seriously. I mean, the fact that, so most countries, just so you know, most countries do not get to depreciate real estate that they bought used. Only brand new real estate gets depreciated. Well, it makes sense. Once you depreciate it once, why do you get to depreciate it over and over again? In the U.S., literally, here's what could happen. I could buy $1 million property. I could rent it out, hold it for a year and a day. I could then sell it to you. You could then hold it for a year and a day, sell it to Brandon, and he could hold it for a year and a day and sell it to somebody else. And each one of us would get the depreciation deduction, and none of us would have to pay tax.
Wow.
So it's like, I looked at this new law and I'm just going, are you kidding me? I mean, in 1986, the last time we had this major tax legislation, real estate got hit hard. I mean, that's way before your time. But real estate got hit.
I only know a little bit of it.
Real estate got hit so hard that it put an entire industry, the savings and loan industry, out of business. That tax law put an entire industry out of business, collapsed an industry. And this time it was just the opposite. It's actually taking an industry that would normally go through major cycles and that is really at the top of a cycle right now.
Right.
And it's extending the cycle. That's what it's doing.
Jeez, man. Oh my goodness. Wow. So this is actually a perfect segue, I think, to some of the specifics on the changes, this new tax law that we're in now. But this has blown my mind. This is absolutely amazing. Can we talk about some of the specific changes, maybe like a few key highlights?
Yeah. So the big one, like I said, is bonus depreciation. So bonus depreciation basically says this. When you buy a property, you're really buying four things, right? You're buying the land, you're buying the building, but you're also buying all the improvements on the land, like the fencing and the lighting and the landscaping. And you're also buying the contents of the building, the window coverings and the flooring and all that, and the cabinets and all that kind of stuff.
Right. All the specifics.
Well, now the land improvements and the contents are deductible the day you buy it. So 100% the first year.
Wow.
So even if it's used property. So typically you're talking about 30%, 25 to 30% of that purchase price is probably land improvements and contents. And that means that's a 30% deduction up front, which means on that $1 million building, that's a $300,000 deduction. And you might have only put in $200,000 to buy it in the first place because the bank put up the rest. So there's your 150%.
Oh my gosh, that's amazing. So now real estate is definitely so much better to buy.
It's better. It used to be that you had these great tax benefits in oil and gas, and only oil and gas got these great tax benefits. Well, now, the first time in history, real estate is better the first year than oil and gas. First time in history. And so you're actually getting the deduction for more than you put into the property, which is just totally blows me away. But that's bonus depreciation. But it doesn't just apply to real estate. I mean, Brandon will tell you, you're a small business owner. You go out and buy a truck for your business. You're going to the extent you use it for business, you can deduct it the first year, right? So you go buy an $80,000, 4x4 pickup that you're using only in your business, you're going to get an $80,000 deduction, even if you put nothing down. Even if the dealership loans you the entire $80,000, right? Zero down cars is easy.
No.
Section 179 is beautiful.
It's not 179. Now it's bonus depreciation. So you don't even have to rely on 179. Here's the difference, just so you understand the difference. Section 179, which is what we've already relied in the past, first of all, is limited to $25,000 on a truck. Okay.
Right.
Second of all, it can't create a loss in your business.
Right.
But let's say you've got a business and that big deduction creates a loss. Now you can offset other income with it. So let's take that $80,000. You've got an $80,000 bonus depreciation. It's not 179, which is a big distinction. You've got bonus depreciation, $80,000. You've got a loss. Let's say it creates a loss in your business of, I don't know, $30,000. Well, now you can use that $30,000 loss to offset the wages from your spouse's business or from their job. So it's all of a sudden it's this huge deduction that you could not get before, and that's just on a car. So it just goes on and on. It just goes.
Oh my goodness! I am literally blown away right now. This is so impressive.
Okay, so bonus depreciation, that's a big one, right?
Right.
It's not the only one. The one that a lot of people are talking about is tax rates, right? So, your corporate tax rate went from 35 to 21%. Well, most small businesses, don't you, and you never, by the way, never, ever, ever put investment real estate in a corporation, okay? Just so I'm clear, never, ever, ever put investment real estate in a corporation. There's all sorts of bad tax consequences when you do that, okay?
And by corporation, you're talking about a C Corp, right?
Or an S corporation. I'm talking about any corporation. Okay. We don't put investment real estate into a corporation. There's just nasty consequences.
Got it.
Okay? Potentially.
LLC.
So we use an LLC that's taxed as a partnership or even sometimes a sole proprietorship for investment real estate. But you've got these corporate tax rates went down 21%. Well, in order to get that to fly with certain members of Congress, they wanted a tax break for small business owners. And so what they gave them was what we call the qualified business income deduction, which is basically saying we're only going to tax you now on 80% of your net income. That's basically what it's saying. We're only going to tax you on 80% of your net income. So we're going to give you a 20% free ride. 20% of your income from your business is not going to be taxed.
Gone.
It's not taxed. Okay? So, it'll take a 37% tax rate and push it down to 29.6%. That's how big that deduction is potentially. Now, just so everybody's clear.
Here we go. All right.
Brandon knows there are lots of details on this one.
Right.
Okay.
Especially once you hit that 157.
What's that?
It says, especially once you get past for the married filing joint, I think it's 157,000 on your income. Then it starts to trade into like specified businesses and so on and so forth. It can get kind of tricky once it hits the phase out stage. Real estate's got
so it's and just to be clear, it's 157,500 for a single person and 315,000 for married. You know what? Most businesses though are not even going to be subject to that rule. There are businesses that are literally multi-million dollar businesses that are going to get this 20% deduction. Actually, I am familiar with there's a very big company that will probably get as much as $100 million in tax deduction because of this tax benefit. Okay, which is nothing compared to the reduction from 35% to 21%. Okay, so Apple and Google and all those guys, they got much bigger tax breaks than this one.
Right.
They effectively got a 40% tax reduction.
Jeez.
That's what they got, 40%. right? 35 to 21. I mean, a huge, huge, huge tax reduction. Small businesses got a 20% tax reduction. Still not bad.
Right.
Guess what? The people who are employees, not only did they not get those additional tax breaks, they actually lost tax breaks. For example, you used to be able to deduct moving expenses when you change jobs. No more. You used to be able to deduct investment expenses. No more. You used to be able to deduct tax preparation fees. No more. You used to be able to deduct all your state income tax and real estate tax. Now that's limited to $10,000. So there's a lot of limitations that were put on wage earners that were not put on professional investors and business owners.
Right. And guys, if you are not familiar with the cash flow quadrant, you need to get very familiar with that now, like yesterday, right? I mean, Tom is literally telling you that business owners and investors is where you need to be. That's pretty much where it is.
Well, you get to choose, right? I mean, you want to pay high taxes, then, you can be an employee, or even self-employed people, by the way, can even get hit harder. I mean, because they've got self-employment tax, and they've got also, that's something that you can deal with. But as an individual employee, I mean, the good news is rates went down and child credits went up and the standard deduction went up. But there's not a lot you can do to change your tax situation if you're just a W-2 employee and you're not going to become an investor or a business owner.
Absolutely. And we've spoken about this on the podcast many times. There have been links to the cash flow quadrant. I'll make sure there's one in the show notes page here as well. But guys, you definitely need to get familiar with it. Remember, we're talking about the 4 types of people, right? People.
4 ways to earn income, right? Employee,
right.
Self-employed, big business, and professional investor.
Exactly.
It's a great book. It's one of Robert Kiyosaki's best books. It was actually the second one in the series after Rich Dad Poor Dad. And I'm on his radio show fairly frequently. And we always get, at the end of the radio show, they always do Ask Robert, and they always say, what's your favorite book? And I would say a good portion of the time it's Cash Flow Quadrant, because it's really eye-opening as to the difference between what happens the way you earn the money. And certainly from a tax standpoint, the way you earn your money has a huge impact on how much tax you pay.
Absolutely does. Absolutely does. And I'm sorry, but you talk about it in your book too, right? So, I mean.
No, of course.
Yeah. So you can get it from his book as well.
My book is a Rich Dad Advisor book. So.
True. Exactly. So it's all in the same anyway. So regardless of where you get this information, make sure you get this information, guys, because it's absolutely valuable. Wow, Tom, thank you so much. All right. So we've got a couple maybe specific questions to some stuff. I think Brandon had a question. Brandon, you want to go?
Right, yeah. So mine was actually in relation to the qualified business income 20% deduction, in particular with real estate. So this is going to work out as a good platform for this. I know a lot of people that will own real estate rental property, and they'll have like their cousin or their brother, somebody help them out to kind of maintain the property while they're out doing their thing, especially with their active duty. I guess the one of the things that's kind of murky is that with the qualified business income deduction, the real estate investor, the owner of the property, has to have the 250 hours of, which essentially is active participation. However, if you have someone that would be a relative who would assume be indirectly owning the business, does that hours still work towards the owner of the property?
Well, the idea is that it needs to be an active investment. So that's really the idea behind these regulations. Is they were trying to figure out how do we give a bright line test so that we don't include triple net leases. So for those of you who don't know what a triple net lease is, this is a lease where basically the tenant pays all of the expenses except for the mortgage. Okay, so a good example is Walgreens. If you want to, Walgreens, it doesn't own any of their real estate. They go find a corner, they build the property, they buy the real estate, they buy the land, they build the store, and then they sell it to an investor and lease it back for 30 years. And they do it on a triple net lease. Well, that's not going to qualify for this qualified business income deduction. Now, here's what's interesting. for investors who use leverage, they're never going to get the qualified business income deduction anyway, because they're going to always have a loss. And the reality is, in my mind, if you don't have a loss from your real estate, you're doing something wrong. So if you actually are qualified for the qualified business income deduction, I think it's a mistake. So that's my take on it. I mean, real estate is such a good tax shelter. Why do you have taxable income from it?
That is a great point. That's a really good point. And guys, again, leverage, right? We were talking about that same thing, using other people's money, right?
Yep.
To build your own lifestyle and your income. I mean, come on, that's it. So we already talked about putting your properties in LLCs, right? Versus as corporations, C corporations.
Sure.
Now, the military has a very specific thing where we move around from base to base throughout the country, sometimes around the world. But one of the questions is it better to put all of your properties into one LLC, or is it better to have them in separate LLCs?
So that's a legal question. I'm not an attorney. I will tell you what my attorney friends tell me, okay? I think it's a very personal decision, because really what you're doing is the goal is to protect your assets from a lawsuit, right? That's the goal. And so the reason for an LLC is because you're trying to protect the assets in the LLC from a lawsuit against you personally. That's the reason you use an LLC. That's one of the primary reasons. Now, anything that's in the LLC, let's say that you have a slip and fall, right, on your property. And by the way, just if you ever look up in the dictionary, you look up the word tenant, and you'll see the definition just as plaintiff.
Plaintiff, really? Wow.
Because every real estate investor eventually gets a lawsuit. Every single one.
All right.
I had a great tenant. He was a terrific tenant until he lost his job. And then he lost his job, and all of a sudden he was telling me that he'd hurt his knee walking up the steps to his house, right? And he'd been in that same house for 3 years until all of a sudden, I hurt my knee because this is out of code, right? I mean, that's the kind of thing that happens. So the idea of the LLC is that they're going to sue the LLC, right? That's because that's who owns the property. Right. Well, if you have a lot of different properties in that same LLC, then they could get any of those properties, right? They could force a sale of any or all of those properties. And so that's why some people like to break out their real estate into a number of different LLCs. And it's just to protect them in case of a lawsuit. Now, what's the chance of a lawsuit? Well, the chance of a lawsuit, if you're a serious real estate investor at some time in your life, is probably close to 100%. Okay. Any one property, who knows, right? But if you're a serious real estate investor, if you own 10 or more properties, chances are at some point in time, unless you're really lucky, you're going to get sued. And I don't know, there's a whole lot you can do about not getting sued, but what you can do, you put in the LLC and then make sure that you've got good insurance coverage, because the best thing about insurance coverage, and I'm talking about like an umbrella policy, I'm sure you talked about this on your show. The best thing about this umbrella policy is what you get with it is not just coverage. You get an attorney from the insurance company to handle things. You get the adjuster from the insurance company to handle things. So the same guy who complained about, slipping and falling, property manager I didn't. Property manager talks to the insurance company. Insurance company has an adjuster. I get one call from the insurance company and never hear about it again. It's done. Well, it's because I've got the insurance company covering my back. So, you do have to have insurance. I like both the LLC and the insurance, but I'm saying that as a real estate investor, I want to be clear. I'm not saying that as an attorney, because I'm not qualified.
That's completely fine. Yeah, no, absolutely. Absolutely. That's awesome. Okay, cool. So one of the other questions we want to ask is, what can real estate investors do right now? And I know we've already spoken about a lot of other things, but from the simple, right? What can investors do right now to reduce some of their taxes? Like, what are some of the key mistakes that people make?
Well, I'll tell you one. A big one is not claiming a home office. I mean, that's actually a really big one. A lot of tax preparers warn people away from home office because they say, "Oh, this is a red flag." Well, I will tell you, in 1996, this was a red flag. But in 1997, it stopped being a red flag. So that was over 20 years ago.
Wow.
So unfortunately, what happens in our industry is that the old guys like me, right, a lot of them don't keep up on the law. And so they remember that this was an issue because they were taught by their mentor this was an issue. And then they pass it on to young guys like Brandon that, hey, this is an issue. You shouldn't, warn away from home office. That's a red flag. Well, if you do it right, if actually you do it the way the IRS wants you to do it, they don't even know you have a home office. There's no place to report home office if it's done properly. Okay. So it's only if you don't, it's only if you're lazy and you report it on your Schedule E and you don't have, a partnership, you don't have a separate tax return. That's the only time you're going to report it anyway. Well, here's what happens. So you're losing all these deductions of the home office. But on top of that, you're probably reducing the amount of tax benefit from your car. And the reason is because the first trip you take during the day is a non-deductible commute. It's a personal expense. And the last trip home is a non-deductible trip. It's a non-deductible commute. Okay, but if you have a home office, your commute's 30 feet. So that's your first trip and that's your last trip. And that's according to the IRS instructions, by the way.
What?
I'm telling you what the IRS says.
That is amazing. So
most people, if they had a home office, they'd increase their automobile deduction. They'd probably double their automobile deduction simply by having a home office. So I think, to me, that's a really big one. There are others like education and meals. Meals, by the way, you may have heard that meals are no longer deductible. They're still deductible. And you just have to have a business purpose and have a discussion and it really has to be a real something that's going to help improve your business. But I'll tell you what, I haven't met very many people that had discussions at dinner that were real estate investors that had that went out with their spouse to dinner and didn't have a business discussion that helped their business. So this is sometimes date night becomes a business meeting, and it does legitimately. My wife's a CPA, so we talk about taxes all the time during dinner. It's very exciting.
There you go. I'm sure.
I will say that is much different than my discussions. My wife is not a CPA; she's a preschool teacher, so I don't get to talk taxes at dinner.
Yeah, but see, here's the thing with you, Brandon. So my first wife was a music teacher. She taught 5 speckled frogs, right? And so she had her only interest in money was spending it. However, what I found is that she was really good at giving me a perspective of the average person, okay, that wasn't. And so I would run business stuff by her all the time. And I found it actually very, very useful to have a sounding board that was somebody that wasn't in business, that didn't have that. So I don't think the fact that your wife teaches preschool necessarily precludes some of those discussions from being tax deductible meals.
All right. Awesome. And hey,
I like that.
Yeah. And hey, guys, for those of you who maybe your spouse is not necessarily on board yet, talking about some of these things and maybe trying to get them on board, or just asking them certain advice, right? That is awesome. That's a good way to do it.
Right.
It's a good way.
But if I'm not mistaken, too, in the language for the Internal Revenue Code for meal deduction, it doesn't even say that you have to receive income as a result of that business discussion for the meal entertainment to be deductible.
You don't. There's four tests that you have to meet. There has to be a business purpose, which is the easiest one to meet. It has to be ordinary, which means that it would be typical for you to have that kind of a discussion in your business, and typical amount of money. You can't go buy a $3,000 bottle of wine. Right. And it has to be necessary, which means that the purpose of the meal, the purpose of the discussion was to improve your business. Okay. It doesn't have to directly result in in additional money, but it does have to have it has to be, look, I'm going to make more money from having these kinds of discussions. This is going to expand my market, or this is going to improve my profitability. And then the fourth one, of course, which is actually should be the first one, is documentation. You have to document it. These days, what we found with the IRS is that they are more concerned with documentation than with the law. If you don't have the documentation, they don't even get into the law. They don't even care. And so they will always start with the documentation. And some of the IRS auditors, don't understand anything about the law. And so they're only going after documentation. I've seen that in an audit where they had no clue on the law. They went after the documentation. In this case, the taxpayer had all the documentation. So they ended up with no change, even though there were a couple of things in there that they probably should have discovered. Now, as a taxpayer, you're under no obligation to alert them to those things.
Right.
You know, if they're not black and white. If they're black and white, you should be alerting the IRS. But if they're not black and white, you know, there's no reason to bring up don't muddy the water.
Yeah. That's fair. That is fair. Awesome, man. Well, Tom, thank you so much for the nuggets of wisdom that you've given us on this show. This has been absolutely amazing. We know you're a busy man, so we want to get you out. But we've got 3 last questions, if that's okay with you.
Go for it.
Just so our audience can kind of get to know you on a personal level. So we've got, what is your favorite book?
Oh, my favorite book. My favorite book is, it's a tough one. It's right now, it's The Power of Now. Right now, it's The Power of Now.
By Eckhart Tolle. Yeah.
Phenomenal book.
Awesome. Yeah. We definitely, we actually heard that from Robert when we had him on the show too.
Well, he's the reason I've been reading it, right?
Yeah. He says the whole team reads it. So that's great.
We do. We've been studying it.
All right. Awesome. Next one is, who is your biggest hero and why?
Boy, that's a tough one.
Get them the tough ones.
I actually think my biggest hero is my mother. She was brilliant. She passed away several years ago. Absolutely brilliant. She learned to read when she was 4, could read upside down as well as right side up.
Wow.
Was a speed reader, graduated from high school at 16, and raised 6 kids, and was just and she was the controller for my dad's printing company. And
wow.
she was a very good, we were friends. She was not your typical mother. She's, not the one where you go to with, all your scrapes and bruises. I mean, she did that, but, I'd more likely go to her with a literary question, or, wow, how do I handle this or something like that. She's just, she had a very big perspective on life. She always felt like, for any single question, there were probably 50,000 answers, and we probably only looked at 3 of them.
Wow. That is awesome. Oh, man. And amazing woman to have produced an amazing gentleman such as yourself, sir. So it's impressive. Last question. If you have 3 nuggets of wisdom to share for those who are looking to get started in investing, what would you offer them, sir?
Oh, first of all, get educated. I mean, first and foremost, get educated. Don't be doing this without the education. Mm-hmm. Okay. Second of all, I would say that don't be afraid of it. It's not something to be afraid of. And to that point, I would say the third one is that nobody cares more about your wealth than you do, and nobody can build your wealth like you can. And so that's actually why we chose the name Wealthability for our company. It's your ability to create wealth. And the big lie on Wall Street is that you're not smart enough to handle your finances, so you should turn your money over to them. And that's just a lie. Mm-hmm. And you just need to know that that's a lie intended to separate you from your money. So you have total ability. You actually end up with less risk if you control your investments. You end up with lower taxes if you control your investments. And you end up with much higher returns if you control your investments. And you get to control them. I mean, I'm the youngest of 6 children. Control is a good thing when you're the youngest of 6. So,
right.
You know what? I just think that you can do it. That's what I would say. You can do it.
Outstanding. Tom, thank you so much. Really appreciate it. And we want to ask, what's next for you?
So we are building, and Brandon, I would love to talk to you about this. We are building a network of CPA firms around the world to actually help their clients. And I am training this network, and we just started this last year. And our eventual goal is 10,000 CPAs around the world. And because we really want to change the way people look at taxes, the way people look at money. And the way to do that is through the CPAs, because that's their, a person's most trusted financial advisor is going to be their CPA, their tax advisor. So we are building that network, and that's where all my energy is going.
Amen. All right.
Yeah, absolutely. I'd love to talk to you about that.
Yeah, absolutely. Give us a call, Brandon.
I'm on the same. Sounds good. Yeah, because I'm on the same base with you. I think too many people are afraid of taxes to try to understand it. And if you could change that perspective, you're doing your clients a lot of justice.
Amen.
Agreed.
Amen. Awesome. So, all right. So thank you so much, Tom. How can our guests get in touch with you?
So just go to our website. We have an amazing website, wealthability.com.
Right.
It's just wealthability.com. And it's a terrific website. I certainly, of course, I'm a little prejudiced, but I highly recommend Tax-Free Wealth for the book to read. It is the book. Everybody tells me it is the book to read on taxes. It's very simple. It's basically, I get to tell a lot of stories in that book, and it's a lot of fun. And it's been updated. It's in a second edition, so it's been updated for the new law.
Okay, awesome. Guys, make sure you go check that out, and there will be links to all of the ways to contact Tom and his team on the show notes page. Tom, thank you so much again. I really, really cannot thank you enough. This has been so valuable.
Awesome. Thank you, guys.
All right.
Yeah, it was a pleasure meeting you, Tom. Thank you.
You too, Brandon.